Stagflation. What is it? Is it coming? Is it already here? That's an old 70s concept that we're going to, I guess, need to reintroduce people to in the current time. So we'll do that on the program this week, along with talking about a guaranteed 7% that, yes, in fact, does exist on an investment that is backed by the U.S. government. That's kind of fascinating, right? How's the U.S. government that's, aren't they kind of broke backing something like that? Well, we'll tell you what that is here on the program. So welcome and good morning. This, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. You happen to be listening to one of the longest running radio programs in all of Central Florida, coming to you on a host of radio stations throughout the region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So if you're not a subscriber, you should be. That way you know when we put up new content. So go to your favorite social media podcast platform and make sure you subscribe to us on those various channels. So the week that was certainly choppy would be a good word to describe it. Some interesting economic data, along with a lot of earnings announcement. If you listened to the program last week, we were talking about that. The FANGs, if you will, those companies that make up that acronym: Facebook, Amazon, Apple, Netflix, Google, those names. And if you toss in Microsoft, those names have been the leading drivers of the overall markets for the past several years. Big responsibility for why the markets are up as much as they are over the preceding 5-year period. And so last week we talked about the N in the FANGs. That was the one that had earnings last week. Not so good for the folks at Netflix. Year to date, that stock is down a tremendous amount. And so this past week was when the other 5 were going to come forth and let investors know how the first quarter of the year 2022 went. Well, it was a mixed bag, if you will, and you certainly saw that play out in the markets. Some days down, some days up. Certainly choppy is a good word to describe it. Perhaps out of all of them, Amazon sort of took the cake, and I guess that's negatively took the cake, with its first loss since 2015. That's an amazing run if you stop and think about it. But Amazon recording its first loss since 2015, obviously that had some reaction in the markets. But the interesting day, I think, was Thursday, because that was the market's best day for the week, up 2-3%, depending upon which index you like to follow. But the headline on that day was actually quite negative economically. The headline on that day was that the economy for the first quarter of this year had actually contracted, had actually been a negative number, negative 1.4 to be precise, which I guess is a number that surprised a lot of folks, because most economists thought it would be at least a positive number, probably around 1% or something like that. But lo and behold, wound up being, that's a pretty significant shift when you stop and think about it. If you think it's going to be 1 and it comes in at 1.4, and you're talking about the U.S. economy, that's a big number, a big shift that proves, I guess, just how hard all of this economic and market predicting really is. Even when you think you might have a grasp on it, the actual numbers can defy the expectations. And that certainly was the case for the economic numbers that came out for the first quarter of this year. So now that we've got that earnings and economic background, let's talk about some terms, 2 of which that you're probably going to hear a lot about as it relates to the economy, And so we want to get those on the table so that you understand what these terms mean and how they relate to the economy. Term number one is the R word, recession. Let's get to the technical definition of what that means. That is a decline in GDP, gross domestic product, called the economy in normal common terms, for 2 successive quarters. So it's going to be 2 in a row. And I guess we just racked 1. So what happens in the second quarter could be interesting, because if it's another negative number, then that meets the technical definition of a recession. Now, the reality is, though, that recessions in the economic cycle are perfectly normal. If you've been an investor for any period of time, you've seen the ups and downs of recessions. And as we said in our email that we sent to our clients on Friday, it is a normal part of the markets. Always has been, always will be, and that is just part of it. The bigger issue, which is why it was interesting to see the markets react positively, right? So wrap your heads around this one, if you will. The economic data came out, negative GDP. Market had its best day of the week on that same day. Why? And this is one of those things where you kind of sometimes leave yourself scratching your head. Well, the markets, we believe, on Thursday may have been thinking, hey, the Federal Reserve, they may see this economic data and decide to pause, decide to slow down a little bit on their announced pace of interest rate increases. So I think the markets might have been a little optimistic that maybe the Fed would maybe slow down a little bit. The reality is, though, that if they do that, and understand the pace that the Fed is on, right? They've made it clear, or at least in most reading of the tea leaves, that in May, that they're going to raise interest rates by 0.5 point. That'll be the first time they've raised it by that much in many, many years. Typically, they've been going at 0.25 point increments, but in order to get in front of inflation, then the raise to 0.5 percentage point is certainly on the table. The problem is that if the Fed blinks, let's say they come out and they say, oh, okay, maybe we'll only raise it by 0.25 point because we got this economic data from the first quarter. The reality is, though, that blink, if you will, is exactly what the Fed did in the 1970s, meaning they didn't do enough to curb inflation. And look, a lot of people are interpreting the first quarter economic data as a representation of some of the issues that are still ongoing out there in terms of supply chain. Some of the reason why that economic data in the first quarter was negative had to deal with exports and how those get calculated into the economic number. But what you don't want is a Federal Reserve that blinks in the face of inflation. So the market might have gotten a little happy on Thursday with the thought that maybe you wind up getting less interest rate increases, but you gotta be careful with what you wish for. So we'll talk more about that when we return after this break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. We're back talking a little bit about the one-pager that the folks at Social Security recently published, talking about will Social Security be there for me, a little one-page sort of synopsis, talking about the notion that there's 2 different trust funds, that in fact Social Security has been on the brink of needing substantial changes in the brink, because it was on the brink of depletion of assets in the past. That was in 1977 and again in 1983. If you're keeping score, that also corresponded with periods of high inflation, particularly when you have to start paying out much more money to folks because of inflation, because as obviously Social Security indexed to inflation, that can really start to accelerate the depletion of the assets. So that's an interesting thing to watch. If we are in a period of extended higher inflation, and we think at the end of the day, regardless of how all these supply shocks and labor shortages and all of that play out, that you very well could be in a period of time where you see baseline inflation. Once all of this sort of stuff works itself through involving COVID and supply chain and stuff like that, that at the end of the day, you might very well see inflation at 3 or 4%. Well, that's not that far off of historical averages. The reality is, though, in comparison to the past 20 years, that's quite a bit more when you think about where inflation is and has been over the course of the past 20 years. So anyway, there's one pager which posits the question, will Social Security be there for me, courtesy of the Social Security Administration. As we said prior to the break, interesting tagline, securing today and tomorrow. I guess the tomorrow part is a question mark because that's the question that the one pager asks. Anyway, Social Security in the future. The combined two trust funds will be able to pay full benefits in full until 2034. After that, they'll still be able to pay. So they're like, yay, but that's only 75% of each benefit due. So that's a 22% reduction. Interesting. It's kind of those things how you play with the numbers. Hey, we're still able to pay 78%. Well, okay, that sounds good. Well, but the other way to say that is all the benefits are subject to a 22% decline. That doesn't sound as good, does it? Anyway, Social Security is with you. The one pager. Hope they didn't spend a lot of money on this, but they probably did because it's the government. Social Security is with you through life's journey, securing today and tomorrow. Well, at the same time, at the top of the sheet, see, for our YouTube audience, we're going to hold the sheet up. It's this thing right here. At the top of the thing, it's asking, will Social Security be there for me? Interesting. Certainly interesting perspective. I'm sure next time our National Social Security Advisor at Nelson Financial Planning, Rob Field, is on the program, we will have more to say about that. Speaking of things to talk about, we, of course, welcome in our audience at Dollars and Cents. This, of course, is a program where we try and make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, along with a top 25 financial planning podcast and a host of social media and podcast platforms. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team stands ready to help you this week change your life with a successful and cost-effective financial plan. Boy, maybe you might want to double check those costs that you're currently paying, especially in an inflationary environment, right? I mean, every dollar counts, right? Speaking of every dollar, though, have you heard about this investment? And this, folks, is 100% legitimate, guaranteed by the U.S. government. Won't lose money, won't lose value. Paying today over 7%. Pretty amazing, right? So what are we talking about? Well, we're talking about I-bonds, inflation-adjusted U.S. savings bond. You remember them, right? The double E's, right? I mean, we all had them when we were younger, and they were very, very popular. A lot of programs were out there 30, 40 years ago that, allowed you to easily put money into Series double E bonds. Well, along the way, there has been another savings bond that you could have been doing, and that is the I-bond, the inflation-adjusted U.S. savings bonds. Well, those are obviously, in today's environment, getting much more attention than they ever had. Here's the numbers, and here's where sort of the secret, if you will, about I-bonds may be not so secret anymore. The past 6 months, folks have put over $11 billion in purchases for I-bonds versus the comparable 6-month period of time in 2020 or 2021 when that was less than a tenth, 1.2 billion. So 10x fold increase. Why? Well, because they are inflation adjusted. So that means that they're paying a considerably higher amount than what you're getting in your savings account. So how do they work? So they work, okay, just like a traditional savings bonds, much like those double E's that folks might be more familiar with. They pay interest and they're backed by the U.S. government. The key differential, though, for an I bond is that the rate that they pay is linked to the CPI, linked to the Consumer Price Index, which the CPI at 8.5%, highest since December 1981, causes those interest rates on those I bonds to go up and pay a pretty good rate. In terms of how they work, that interest is paid when the bond is cashed. So you don't pay taxes along the way. It earns interest monthly from the first day of the month in the issue date. So if you buy the bond on, say, April 28th, you actually get the interest for the entire month, which is a pretty good deal. And then lastly, in terms of kind of the three things that you need to be thinking about in terms of how they work, the interest is compounded twice a year, and it accrues for up to 30 years or until it's cashed. So that's kind of the mechanisms of how the I bonds work. Traditional savings bonds, but instead of the traditional savings rate, it's indexed to the CPI, it's indexed to inflation. It pays the interest pays and accrues on the bond on a monthly basis, and it's compounded twice a year, meaning that the rate also changes twice a year. So here's the catch, if you will. Because those bonds compound twice a year, and again, compounding twice a year that's much better than compounding once a year, right? Because when you compound something, that means the profit that you got for that period of time goes into the principal amount that then the future interest rate then gets calculated upon. So that's the beauty of compounding along the way. When that compounds twice a year, that means that the I bond that you own is going to be subject to at least one rate change during a 12-month period of time. So here's the question. Is the rate, the inflation rate, at its peak, or is it not? It'll change in May, and it'll change again in October. In May, which is next month, actually it's this month, right? It's this month. so for this month of May, it's going to change again. It's going to go from 7.1 currently to 9.6 in May. Understand that the rate is not set. It fluctuates. So that's caveat number one that you need to be aware of as it relates to these I bonds. At the end of the day, if inflation remains high, then you're going to get a pretty decent return on these bonds. Now, here's the other catch, and this is the one that you need to be most aware of. There's an annual limit. It's not like you can turn around and put $100,000 into these things. There's an annual limit of $10,000 per person. Now, it's not a particularly large amount. There is a separate program that allows you to do $5,000 of your tax refund into I bonds. So that is another option that you could be doing, that at the end of the day would be a way to increase that, but know that the annual limit is quite small in terms of how much money you can actually put into that. There's certain strategies in which you can kind of get multiple owners, but it's based upon an annual limit of $10,000 per person. So if you got $50,000 in cash, let's say, okay, great, this works for 20%. Doesn't solve all the problems, but just know that it's a much smaller limit. We're going to take a break. When we get back, we're going to have a continued conversation on these I bonds here on Dollars and Cents with Joel Garrison, Nelson Financial Planning. Refreshing investors in our listening audience on a couple of terms and what they mean and what the impact could potentially be for folks at the end of the day, particularly economically. Thinking about, we were talking in the last segment about the technical definition of a recession, especially in light of the negative economic number that came out for the first quarter this past week. Also relating that to the Federal Reserve. And remember, the Federal Reserve's role is to raise interest rates to help combat inflation. Well, a lot of people would say perhaps they are late to the game, so they've got some makeup to do, which is why they've announced they haven't announced, but it's widely expected that the interest rate increase in May is going to be 0.5% versus 0.25%. Now, the markets may have gotten a little bit too excited or in front of the story on Thursday when those headlines hit the newspaper, that the notion of the economy going down for the first quarter of this year happened to be the best day for the markets this past week. The reality is that there may have been some unanticipated optimism or unfounded optimism that somehow the Fed would maybe slow down the pace of those interest rate increases. Remember, the Federal Reserve rises interest rates to help curb inflation or stoke economic activity. Well, the reality is that that's exactly what the blinking, if you will, of the Fed, meaning when they announce that they're going to do something or make it very clear that, hey, we're in a raising rate environment, and then all of a sudden they don't do that, that creates the problem of nobody really believing what the Fed is actually going to do, that in fact they're going to blink in the face of inflation. That's exactly, folks, if you read your history books, what happened in the late 70s and early 80s, whereby they didn't do enough to curb inflation. There was then some supply shocks in the form of the oil embargo, and voila, you get to our next term that we're going to reintroduce the listening audience to, which you may be starting to hear a little bit more about, and that is the term known as stagflation. As you might well imagine, that is a stagnant economic growth in the face of continued higher inflation. Slow growth, rising prices, that's stagflation. That is precisely what happened in the 70s, and that's going to be a term that you're going to start to hear more and more of. So we wanted our audience to make sure that they understood where that fits in to the economic climate. Inflation really is the dragon in all of this that the Fed has to slay. And it wasn't slayed effectively in the 70s because they blinked and they didn't raise rates fast enough or as fast as they should have. And then lo and behold, okay, it wound up reoccurring, which dragged out that economic period of time, causing that period of time to be a period of stagflation, stagnant growth, slow growth against rising inflation. Time will tell whether the Federal Reserve will blink or not. It would certainly be our hope that they would not. Now, that may mean higher interest rates much more quickly, but remember, the dragon in all of this is inflation, and that's the piece of economic data that folks need to continue to keep an eye on. Time will tell whether the Fed gets it right or not. Key tips, as we talked about last week on the program, to stomaching all of this is remember to be diversified. Remember to be balanced so that you have different things doing different performance at different times, right? So what that means is that when you look at your portfolio, there should be at least some pieces that are doing better than what's going on in the overall market. Those pieces then become the pieces that you utilize during tougher times, because at the end of the day, and here's what I think a lot of people get tripped up on when they think about their investments and how they're doing and performance and things like that. The reality is that you're not going to use all of your investments today. You're not going to use everything that you've saved over a 30 or 40 year period of time or 50 year period of time all at one shot, or at least I hope you're not. I don't think that should have been the plan, is I'm going to save for 50 years and blow it all on, a single day. And so that's the point of being balanced and being diversified. Different things doing different performance at different times. That's why you are balanced. Or you should be balanced. That's why you should be diversified. And then, of course, consistency. We talked about that on the program. And then, last one, which is a popular one that we like to recommend, turn off the TV. It's only going to raise your blood pressure, and perhaps that's not a good thing health-wise. So, with that, we will shift some gears. Of course, for our listening audience, this is, in fact, Dollars and Cents. My name is Joel Garris, I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. You're listening to Dollars and Cents, coming to you on a host of radio programs throughout Central Florida. Also, be sure to subscribe to us on your favorite social media or podcast channel of choice. Happen to be one of the top 25 financial planning podcasts as well. So with this shift, we're going to talk a little bit about Social Security. There's a one-pager, if you will, floating around from Social Security that's got some good basic introductory material. I'm sure in the weeks ahead we'll have one of our fellow certified financial fiduciaries at Nelson Financial Planning, Rob Field, join us. He's our National Social Security advisor as well, to talk more about Social Security. But I just thought this one pager was kind of interesting that the folks at Social Security had put out. A lot of folks, of course, think Social Security not going to be around or in serious trouble, and probably is in trouble. I'm not sure the degree of seriousness, because there's some important information to know regarding the basics of the program. And what most people don't realize is that Social Security, in fact, has two different trust funds. The first is the Old Age and Survivors Insurance. Boy, that's in need of a refresh of name, right? I mean, would you really call someone, hey, you're old, or you got an old age? No, in today's world, we probably think of some nicer, kinder, gentler term, if you will. But anyway, it is still to this day called Old Age and Survivors Insurance. That's your traditional Social Security, retirement benefits, things like that. The other trust fund is the disability one, the Disability Insurance Trust Fund. So there's two trust funds, one that pays the retirement side, one that pays the disability side, that make up this thing called Social Security. Don't confuse that with the Medicare trust stuff. That's a totally different kind of thing. The reality is that as this one pager goes on, which is about, it's curiously entitled, Will Social Security Be There for Me? Trying to address that issue that I think is on a lot of people's minds. And then its tagline, which is an interesting tagline, given the question that the one pager is asking, securing today and tomorrow. Interesting. If you're asking the question, will Social Security be there for me? Then perhaps your tagline shouldn't be securing today and tomorrow, because it seems like there's kind of a big question going on about tomorrow. Otherwise, you wouldn't have put out the one pager. But anyway, I digress. Transforming to the middle part of it, transforming to meet the needs of our customers. The Old Age and Survivors Insurance and Disability Insurance Trust Funds have reached the brink of depletion of asset reserves in the past, and that much certainly is true. However, in 1977 and 1983, think back, those also coincided with periods of higher inflation, so you're getting some correlation here. Congress made substantial changes, such as raising ages to 67 for full retirement, to the program that resulted in the $2.9 trillion in the trust funds that are today. Interestingly, that does coincide with the inflation, current environment. The last chunk we're going to cover, we'll cover that when we return, talking about this interesting one pager that the folks at Social Security put out recently here on Dollars and Cents. This, of course, is Joel Garris of Nelson Financial Planning. We'll continue the conversation right after these messages. On the program, we're talking about that guaranteed investment that's making over 7% today and going to be shifting to 9% or over 9%. What is it? Well, we're talking about I-bonds, inflation index savings bonds. Certainly, it's beginning to be less of a secret because the amount of money that's poured into those over the course of the past year is about 10 times the amount that has happened in comparable periods in prior years. So certainly getting a lot of attention. On the program, we're talking about how they work, if you will, and sort of what the catch is, right? Because there's always a catch, right? There's not going to be a investment where you're getting that high of a return that's guaranteed by the U.S. government without some kind of a catch. So how they work, we were talking about that in the last segment, but number one, it works like a traditional savings bond. You actually wind up, it pays interest, it's backed by the U.S. government. Biggest difference, of course, is that interest rate is based upon the CPI. CPI coming in at the highest level since December of 1981, so it's like 40 odd years at 8.5%. Hence, their interest rate has shifted up pretty dramatically. The reality is, of course, though, that they do have a interest rate that does pay, just like any bonds pay. It accrues as part of the bond, so you don't pay taxes along the way. It winds up, that interest is added into the bond, and ultimately when you cash it out, then you wind up getting that accrued interest. It'll compound twice a year, so that's good that it has a more regular compounding than just once a year. That allows the underlying value to go up even more, and it accrues for up to 30 years, so it's good for a 30-year period of time. What's the catch? Well, there's two of them. Because it compounds twice a year, that means the interest rate is going to adjust twice a year. So if you buy an I bond thinking, I'm going to hold it for 30 years, it's going to be 7, 8, 9%, because that's what inflation is at right now. That's not going to be the case, because the interest rate on these things fluctuates twice a year based upon the most recent CPI data. So certainly, though, for right now, you're getting a much better rate on it than you would with money just sitting in cash. But that gets us to the other caveat, which is that you can't just take all the money that's in your savings account or money market account that's not paying anything and put it into this, because it's limited. It's limited to a $10,000 annual limit per person. Separate program allows you to do up to $5,000 of your tax refund into an I bond, but the reality is that it's intended to be just available for a somewhat lower amount of money that you can put into these. Along with the fact, of course, as you might well expect, that there is in fact an early withdrawal penalty on these. Not awful, but important to know. Number one, with an I bond, you can't cash it for 12 months. So this should really be, if you're thinking about doing an I bond, this should really be for the amount of your cash savings that you really don't kind of need, or is really the ultra emergency portion of your cash savings, because you're not able to cash these out for 12 months. And there's a penalty of 3 months interest if you cash out in the first 5 years. So you lose 3 months of interest, and they are fully locked up for that 12-month period of time after initial purchase. So that's the story on I bonds, the good, the bad, the ugly, how they work, what's the catch. At the end of the day, certainly if you've got a bunch of money that's sitting in cash and savings, that's part of that overall strategy of owning some money that's not, or having a portion of your money that's not going to be subject to any level of fluctuation. Certainly these I bonds are an intriguing option. Unfortunately, though, because of the limitation of how much money you can put in, and to a certain extent the withdrawal penalties on them, it does make them somewhat limited. But certainly, in comparison to what you're getting on money market rates or savings account these days, these are certainly some interesting options to do with a portion, unfortunately not a large portion, of what you've got in terms of those cash savings. So thought we would spend some time talking about that. Another topic, if you will, that is getting a lot of conversation, probably as we look forward to this month. It will certainly get even more of that conversation, because the interest rate is going to jump up even more than what it was. Again, these interest rates sort of reset themselves twice a year, and so the reset is going to be a pretty good size reset for the month of May based upon the most recent inflation data. So that is the story on I bonds and how they work. Next up here on the program, we're going to talk about some of the things that retirees should be asking themselves today. The big questions, if you will, and obviously I'm looking at the clock. This will have to be something that will carry into next week's program as well. But we wanted to get some of these questions on the table and set the stage for the conversation next week. And we think that the sort of the three questions that folks should be asking in terms of when they think about retirement is, number one, when do you want to do that? That's often the, kind of one of the first questions that we ask and when someone comes into the office for a conversation. And then we back into whether that's a good answer or not, because at different ages, obviously you have different Social Security benefits, different eligibility for Medicare, things like that. But then that gets to the next question, which is, how much do you have, and will it be enough for retirement that sort of matches the goal of the years that you are thinking? So if you're thinking about retiring in 5 years and you only got $50,000, that might be a little bit of a stretch. So number one, it's when would you like to retire? And then number two, okay, well, do you have enough? And then that may have to readjust the answer to question number one. And then the third question is, how do you make sure you're doing the right thing or the smart thing with money in retirement? And that gets into what's the debt look like. Certainly one of the best goals to have when you're retiring or going into retirement is to have your debt fully paid off. And then this is one of the ones that we've certainly talked about this in prior programs, just this particular topic. But the strategy for withdrawal, where you're going to take money, how much, when, and how often, the strategy for withdrawal requires a much greater insight into the nature of the assets that you have, coupled with what your tax return or how your tax information plays out. So those are some of the things that folks need to be asking as they set on the path to retirement. Is, when do you want to do it? Are you going to have enough? Because that answer probably is going to drive whether your answer to the first question needs to be modified or not. And then lastly, once you're there, what's the best way to sort of manage the money? What's the best way to address things in terms of what the debt looks like and how you're spending the money? And then most importantly, kind of what's the strategy for taking money out and generating out income? And there it's important to understand the difference between the different types of assets that you may have, right? After-tax assets, non-qualified assets versus retirement account assets, very different in terms of how they are taxed. So anyway, those are the questions. We'll obviously spend more time next week on the program talking at length about them. We're going to wrap it on up and get on out of here. Enjoy the rest of your Sunday, and we'll be back next week here on Dollars and Cents with your host Joel Garris of Nelson Financial Planning.